Okay, the second, and the one where we'll do a little more review, is near-term planning and decision-making. Looking at planning in the near term, 1 year, or in that range, 18 months, and decision-making, probably the most distinctive change that's happened is that we now try to classify costs according to their behavior or how they react to changes in volume. And we have variable costs, which in total will vary directly and proportionally with changes in activity. Unit variable costs will remain constant, again, within the short term. Fixed costs are just the opposite. The total fixed cost does not change as our volume changes, volume of activity, but the unit cost changes inversely to changes in volume. Just an example, we have a block of wood to make baseball bats, and a baseball bat uses 1 block of wood. Very simple business, and we pay $10 for a block of wood. We rent a machine that costs us $1,000 a month. We also rent a building that costs us $1,000 a month. So if we're going to produce, if we produce 10 bats in March, we would have the following costs: a variable cost and a fixed cost, and then we have total. If we have a variable cost of $10 a bat, a total cost for wood would be $100. The unit cost, again, $10. We have 2 costs that are fixed that do not change as our activity changes. One was the rent for $1,000 on the building, another was the rent on the machinery. So we have $2,000 of fixed cost, total of $2,100. So the total unit cost is $210. We've seen the variable cost, $10, remain constant, and going from 1 bat, let's say with $10, you multiply it by 10, for 10 bats, you'd have 100. So we're proportional, and we're moving in the same direction. Now let's see what happens when we change our volume. If we produce 100 bats in March, our variable cost, according to our definition, is going to increase proportionally with the activity. We've gone up by 10 times, so our total variable cost is $1,000. Okay? But again, the unit cost stays the same. Now what about the fixed cost? Fixed does not change, so in total. But what about in unit? Now we're taking that $2,000 and dividing it by 100, so what is our fixed cost per unit is down to $20, okay, total. So comparing these numbers, I think we see in today's environment where fixed costs are becoming such a large part of our total costs. Look how the cost per unit changes here. And why does it change? Because fixed cost is going from $200 per unit down to $20 because of the volume. So we are getting more and more into an environment in manufacturing now where we've got to maintain volumes. If volumes slip, our fixed costs will basically overwhelm our profitability. So this is why we see automobile dealers at the end of the year when they got too much inventory, basically, selling them at cost just to move them out. The other option, we have fixed and variable costs. We also have mixed costs, all right? Mixed costs exhibit both characteristics. They have part variable, which varies, and part fixed, which doesn't change. The classic example would be an industrial utility bill, where they have a certain fixed cost and then so much per kilowatt hour over a certain level. We can determine this simply, or we can do it complex way, depending on how much data we have. Simply speaking, we can just look at a cost function for a company as consisting of a variable cost and a fixed cost, and that we have a straight line. All right? So if we work in a 2-space with basically our volume on the x-axis, and on the y-axis we'd have total cost and revenue. The cost curve was going to have both fixed and variable costs. If we want to determine something about this variable cost per unit, obviously the variable cost curve is starting at the, so if we have 0 units of activity, we have 0 variable cost. Regardless of what the activity is, we're going to have some fixed cost even at 0. All right, so going back to our cost function and trying to determine which of these mixed costs are fixed and variable, we can just, say that this is the slope, which is the variable cost per unit, and this fixed cost is 1, is the y-intercept, where that curve crosses the y-axis. So we have the total cost, y, is equal to the slope times the volume plus the fixed cost, which is the y-intercept. Now this may look strangely to you like the equation for a straight line. So how can we determine the slope? We got the change in y over the change in x, okay? That's going to give us the slope of this variable cost. So as the cost changes divided by the changes in volume will tell you what the slope is, which is, again, this is our variable cost per unit. And then we can, once we determine that, we can substitute any one of these points for y and x and come up with our fixed cost. So we have separated the fixed and variable components of a mixed cost. This is important because we need to know for the full company which are fixed and which are variable costs. Because what we want to do, we want to develop a new form of income statement. All right? If we're going to compare financial accounting income statement with a management accounting income statement, we have a functional income statement, which is a financial accounting income statement, and then we have a contribution income statement, which is our management accounting statement. You're all familiar with the financial accounting. Revenue, again, we got revenue here. We subtract cost of goods sold. Over here, we're going to subtract variable costs. Here, the resultant is called gross profit. And on a functional income statement, we have the word contribution coming from the fact is that number has to contribute to paying our fixed costs and then providing for a profit. Now, what do we subtract here? We got our expenses or our period costs, and then that would leave us with our operating income. All right, we've subtracted our variable costs from revenue here to get contribution, and what's left is the fixed costs. Same revenues, same expenses in total, and probably the same operating income. What's the difference is that this income statement enables managers to focus on those numbers right there. Because why? Those are the ones that we can affect in the short term. What can we do about fixed costs? Not much. All of these definitions of fixed and variable costs are captured within some type of relevant range and time. Over time, all costs are variable. If you have a 2-year lease on a building, it's fixed for how long? 2 years. But it will change. So again, this is a short-term tool, 1 year, 18 months. This contribution income statement, as I said, allows us to focus on those revenues and variable costs and manipulate them in the near term. When we get into CVP analysis, cost, volume, profit analysis, we can then look at things like break even, which on our chart here would be taking our total costs would start wherever the fixed cost is, all right? 0, we'd still have these costs, and then we go up according to the slope of the variable cost. What about revenues? Revenues would also start at the origin because at 0 volume, we have 0 revenue. And then here's our revenue. Now, why would you think we have a steeper slope for revenues than we do variable cost? Because I sure hope that your price is greater than your variable cost per unit. If not, not much of a profit position. All right, this point here where our revenues intersect the total cost will give us the volume and the revenue at which we are at 0 profit because our total cost equals our revenue. All this area in here is negative income. Up here we have positive income. Once we get in levels, volume up there or above sales dollars, we're into a positive income. And we can also determine our operating leverage at this point, which you learned in your finance class. There's such thing as financial leverage. Well, this is operating leverage, which is the relationship between your contribution and operating income. Now, if you work hard and you get your sales to go up 10%, do you want your income to go up 10% too? It'd be much nicer if it went up 20%, wouldn't it? Your operating leverage is based on your cost function. What percentage of your total cost is fixed and which is variable? So very, very important concepts here.